and welcome to our conversations with Capita. So with me, I have today Evelyn Tay, who's leading the Valuations and Financial Reporting at Capita. So Evelyn, thanks for joining us. Before I'll ask you to introduce yourself a little bit more, I'll give the audience a bit of a preview about what you do at our organization. So Evelyn's been with us for a few years and has been working with our private market clients. So Evelyn has experience in consulting different organizations and startups on equity plan design. And as I mentioned, leading the valuation and financial reporting efforts at Capita. So Evelyn, thanks again for being here with us today. So today's topic is all about 409A. So why don't we just start from the top? Would you mind explaining to me and the audience today what 409A is?
Sure. So essentially 409A valuations, all this really refer to specifically the section 409A of the US Internal Revenue Code. So a little bit of like a history lesson to it. Initially, like in the past, there were not much regulations on like deferred compensation in the US until this particular company called Enron got exposed for some fraudulent activities by the upper executives. So essentially what they did was that they made use of the lack of regulations, whereby they were able to really get like cashed out on all of their deferred compensations at a very low exercise price right before the company actually went bankrupt. So this resulted in them essentially getting to take out a lot of the equity value before the investors were able to get access to it at the end of the day. So then that brought into like how there needs to be a lot more regulation in this particular space. So that's how section 409A of the code came about. And what it essentially says is that there's a bunch of regulations on the deferred compensation in the US, but specifically the key thing that you need to remember is that the exercise price, the strike price of options given out to US individuals must be at the fair market value of the company as of the date of grant. So that's the key takeaway.
Yeah, sounds good. So that's helpful. Yeah. So 409A has been around for a while. I think it was enacted back in January 2005. So obviously there's quite a bit of history, but it's still a topic not everyone's too familiar with, and hence we're having this conversation. So I think an important point to consider, you mentioned like your takeaways around setting the strike price based on a 409A evaluation. But can you help explain exactly who does this apply to? So who should care about the specific requirements?
Sure. So I think one common misconception a lot of people have is that because this is a US regulation, it's only applicable to US companies. But actually the key thing here to remember is that it's not on US companies, but rather on US taxpayers and individuals in that sense. So essentially, as long as you are planning to give out options to US individuals who are taxpayers to the US, then this kind of 409A regulations will apply for you. So even if you are an international company who is deciding to expand a little bit more into the US and you want to give options to US individuals, these rules will apply.
Yep, sounds good. So I think that paints a pretty clear picture. So 409A, a bit of a background, why it was enacted. So obviously infamous Enron case played a big role. And the important key takeaway, which I'm sure we'll talk a little bit more about. So yeah, it's an important aspect that it applies to companies that may not be specific in US international companies. I know as part of audience today, we have individuals joining from India, Singapore, Australia, and the US itself. So we have startups represented from multiple locations. So Evelyn, I guess just to highlight, like, so why is it even important in the first place? So obviously rules are rules and usually should tend to follow. But what are the implications if you are not aware of the requirements, if you don't actually follow them? So why should people care about this?
Yep. So I think one thing to know is that like, rules are rules for sure, but like naturally when you're not compliant, that comes with a set of penalties as well. And especially for non-compliance on section 409A, that is extreme, like it's rather strict, I would say. The penalties are quite harsh. So the key four things that like are like the top of our head kind of like penalties to it. Firstly, like if there's like no actual substantial like risk of forfeiture of the options, etc., then the taxing point can actually be brought forward all the way to the year of granting the options itself. So this is actually quite huge, meaning that as an employee itself, you essentially get taxed just for receiving these options, and you're not even getting any actual economic benefit like realized at that point of time yet. So that's the first thing. The second thing is also that like there may be accrued interest on this taxable amount that you eventually have in the future. So typically there is no interest on your taxable amount when you actually start to realize your options. But if you don't comply to Section 409A, then specific interest rates will apply over there. So you end up paying a lot more. The third one over there, it's clear cut. Pretty much just that there is an additional 20% that you have to pay whenever you pay your taxes at the end. And the final one over there is that like all things else considered as well, your taxes may instead trigger at the point of vesting instead of at the point of exercise. So this is a little bit similar to like the first point as well, whereby essentially you end up getting taxed at a point whereby you don't receive the cash value of your options yet. Yeah. So all in all, pretty harsh penalties that apply over here. So best would be to comply as much as possible.
Yeah, correct. And while you were presenting this and speaking, Evelyn, we had a good question from the audience. So someone's asking about, whether the rules around 409A apply to, contractors, non-employees, advisors. So there's definitely a few things to consider for the US plans. Is you're familiar with options. There are different types of options in the US. We have ISOs, we have non-qualified stock options as well. So generally, the 409 rules apply to all kind of non-deferred compensation. But once again, you need to be familiar with the specific instruments. So in some cases, ISOs cannot be granted to non-employees. That's when non-qualified stock options come into play. So I do encourage everyone else to pop in the questions as we continue this conversation with Evelyn. So anything specific you want to clarify, we can definitely do a deep dive. And then, as always, if you have a specific questions or for your company you want to get a bit more guidance on and get some help from us, we're more than happy to have a chat with you one-on-one separately. Yeah, so don't hesitate to reach out to us. But yeah, we do encourage more questions as we continue this conversation. So look, Evan, to just summarize where we're at, I think we have a pretty good grasp, high level, what 409A is, why it's important, why should people care about it, and what the implications are. So obviously, no one wants to put their employees in position when they have, additional tax burden and penalties. What I kind of want to do next, I want to have a more discussion around the practical, technical aspects and kind of the process involved in getting 409A valuation. So let's discuss how it actually works in day-to-day life. So what does a company need to do to obtain a 409A report? Can you talk us through how that works exactly?
Sure. So I think we'll talk a little bit about like exactly when you need the 409A first. So in terms of actually the process here, right? Typically it comes when from a company's perspective, you are planning to actually give your options out to some US individuals. At that particular point is when you need to start thinking about whether you need a 409A or not. So typically the 409A report needs to be issued before any actual grants are given out to your US individuals. So at that point of time, the 409A will be done. And what it essentially does is that it tries to value the company and discover the fair market value of the ordinary shares at that particular point in time. That 409A report, whenever it's done, will then be valid for up to 12 months or the earlier of up to 12 months or whenever the next substantial corporate action happens. So what we mean by this is typically like if you do a fundraising, so this can be either like an equity round or even a convertible round, then that constitutes as like a significant update to the valuation of the company. And that is also where the expiry of your 409A report would be. So that is the first part of it. And I suppose then the next part is like in terms of like how to actually get the 409A reports from a company's perspective, right? So typically these need to be done by an independent valuer. So there's a lot of vendors out there, and Capita is also one of them. And what they usually require is to really get a better understanding of the company right now. So that means like performance, so financial performance so far, cap table information, what's been raised, everything like that, what's the historical valuations, etc. And all of this can contribute into the evaluation exercise that will be done to eventually come up with the fair market value.
Okay, that makes sense, right? So obviously, as part of the process, you need to obtain a lot of information from the company, kind of understand the business. So you as a valuer to arrive at that fair market value that will ultimately set the strike price for any new grants for employees. So just for everyone to understand a bit more on the technical side, so can you just talk us through a little bit more about the actual process and methodology? How does it actually work? So let's say I'm a company, I provide you my financials, my current statement, my cap table, all the details on the fundraise. How would you go about understanding my business, picking the appropriate methodology, and arriving at that fair market value? Because ultimately every business is different. Some are at pre-seed stage, some are more, more mature. So how does the process work?
Yeah, sure. So I think there's typically like a couple of methodologies we go about to valuing the company. And depending on the profile of the company, like you mentioned, because every company is different, right? So there will be a different type of methodology that would be best suited for the company's purposes. So I think the clearest way that we always go about to doing it is understanding firstly the size of the company. So how large is it, and is it like cash flow positive, etc. And the next thing then would be in terms of like has the company raised any recent funding rounds? So by recent, we typically mean like within the last 6 to 12 months, etc. Then if the answer is yes to cash flow positive, then typically we do rely on what we call the income approach, more commonly known to everyone known as like the DCF approach. So you can run a DCF model on the company itself, and that can be one of the primary methods to valuing the company. And if the company has raised some funding recently as well, you can also rely on the latest funding round information over there and apply what we call the OPM backsolve methodology to derive the equity value from that fundraising round. So these are like two kind of approaches over here. But typically for companies who are in the much earlier stages, and let's say if they haven't had a recent fundraising round, then the best way would pretty much be to go by the market approach, whereby essentially you look at the peer companies in the market who are actually listed, and from there you can try sort of track how they're currently performing, how the performance has shifted through the past like year or so, and you can apply their metrics onto the company itself. So these three would be the most common approaches. But naturally, of course, like you mentioned, Amit, that every company is different, and like there's a lot of different intricacies here and there. So we will have to eventually like evaluate all of those, and we might take like a blended approach using multiple valuation strategies here and there. And also sometimes it gets a little bit creative, whereby we employ a little bit more niche and novel kind of valuation methodologies.
Okay, no, so understood. So I think maybe this is kind of getting in a bit more complex technical area. So maybe let's just take a step back. So the independent valuer that a company can appoint obviously has the expertise, and I'm just trying to address one of the questions from Abhishek raised is that, what should you look out for in the valuer and what are the particular requirements? Some of the things you need to be mindful of is that the third party's experience in working with companies at your stage, and also there's definitely the industry. There's obviously the industry best practices you need to follow. And yeah, like these are some of the examples of approaches that may be utilized if they're deemed to be appropriate in the specific case for organization you're working with. But I guess to take a step back is that no matter what methodology is applied, the ultimate outcome, and we're going to use the term fair market value, FMV, ultimately it's essentially the share price of the common stock. But as you can appreciate that most of the companies, especially are backed by VC funds, is that their structure is a bit more complex. So this is kind of linked to the OPM backsolve and OPM pricing model. Can can you sort of explain the difference between FNV or the ordinary shares or common stock versus preferred shares? How does it all work? And because the important thing to consider is that in most kind of plans, equity incentive plans, is that employees ultimately are entitled to receive the underlying shares. So how does it work versus preferred shares? Can you explain a little bit more for us around that?
Sure. So I think one thing that a lot of, especially in like when we talk about like 409A valuations and approaching from a valuer's perspective, is that the shares in the company, right, the different classes of shares are actually having like a different fair market value. So the way you can think about it is that if, let's say if I were an investor and I want to invest in a private company right now, would I prefer to get like the latest round, like say Series D preference shares, or would I prefer to get ordinary shares and considering they're at the same price? Naturally, I would prefer to get Series D shares, the preference shares, purely because they come with a lot of other kind of rights. So that could be like liquidation preferences. It could also be like drag along rights, etc., voting rights, all of this as well. So from that perspective, these additional rights in terms of the preference shares actually do have some sort of value. So when we do the valuation as well, we have to consider all of these. So it comes in like the order of payments, etc. And that would arrive at a different fair market value for each share class. So in that sense, for the options, because typically most of the time your underlying shares for your share options would be ordinary shares. So what we have to do is not just like find the value of the company, but also to allocate it across the share classes such that we find the fair market value of the ordinary shares itself. And notably, if you do have like a recent funding round, this ordinary share price, the fair market value of the ordinary share price, would typically be like a certain percentage of the most recent funding round price. So that's just something to note. It's not that like if you have recently done a Series D at $150 per share, it doesn't mean that your ordinary share price fair market value will be $150 as well.
I understand. So I think that kind of helps clarify this a little bit. So that makes sense. So thanks for this. What I want to kind of talk a little bit about next is that there may be kind of further confusion. So thanks for clarifying the fair market value in ordinary shares. The next thing you kind of need to consider is that under accounting standards, you also need to obtain fair value of the options you ultimately grant. So for our audience here, could you kind of explain the difference between fair market value versus fair value of the options once they're granted? How does it all work? What's the difference? What's the relation between the two?
Sure. So the fair market value of the ordinary shares is pretty much just that. It's for the ordinary shares themselves. But so when you want to find the fair value of the options itself, then you're essentially trying to find the value of two different instruments. They're very similar and they are linked in the sense that because the underlying shares of the options are the ordinary shares, but ultimately they do have two different values. And that's what we call the fair market value of the ordinary shares and the fair value of the ESOPs itself. So for the fair value of the options, you have to go one step further, whereby you have to essentially do an option valuation on all of these share options. So this could be like either the Black-Scholes or binomial, which are the two most common kind of valuation methodologies for options. And if it's a performance-based, it goes into Monte Carlo as well. But that's like a little bit too a separate conversation we can have on that. Yep. So essentially for the fair value of the ESOPs over there, you have to apply these option valuation methodologies on top of the fair market value in order to find what really is the fair value of the ESOPs itself.
All right, no worries, that makes sense. So in a way, the step number one for all companies is always to get the fair market value first, which is the essentially share price at the point in time for the ordinary shares, which employees are entitled to ultimately receive once they exercise their options. And once they've been granted, based on that 409 valuation FMV, which sets the strike price, the next step is, because you need to amortize and expense it based on accounting standards, in US, it's obviously US GAAP. It's like ASC 718. Other international companies may follow IFRS. So IFRS 2 is the accounting standard. So the fair value determines your expense. They need to essentially amortize over the vesting period. They will hit your P&L. So that's kind of the difference between the two. But yeah, I think that's like a common thing that may be a little bit confusing. So just I want to take a quick pause here because we had a follow-up question from one of the members here. And this is once again just around the requirements for 409A for employees and non-employees. So, and I think it looks like Abhishek already provided some comments, so we'll have a good discussion happening here. Yes, so definitely 409A does apply across the board. So as Evelyn kind of mentioned at the start, that any US-based participants will have to be considered. And when you design your plan, obviously you may need to include the relevant language so ensure that the plan actually complies with Section 409A requirements of the IRC. So the short answer is yes. You will need to consider the requirements, even if you consider hiring, non-employees or who could be contractors in US. So that's something you just double check on. So you're more than happy to have a further discussion with you on that if that's of relevance. So thanks, Evelyn. So I think like what we've kind of done so far, we've kind of started high level to just understand what 409A is, like why it's important. We've done a bit of technical aspects, which I think can be hard for people to understand, but obviously it's important for you not to just obtain the 409A FMV, but also understand how it is arrived, because ultimately the 409A needs to be fair and defensible. Because ultimately the implications down the track is that if your company undergoes any further due diligence as part of M&A or future fundraising, there may be some scrutiny about how did you arrive at 409A valuation for any grants you've issued previously to your employees. So that is quite important. So with that in mind, obviously there's quite important aspects from employees' potential tax implications and obviously from companies' reputation. So what are the common mistakes, I guess, you see, Evelyn, like in your experience working with many of the companies, helping them on the 409A requirements? What mistakes do you see companies make?
So I think one common thing is really just that a lot of companies don't realize that they actually do need a 409A. And typically what happens there is that they actually give their ESOPs out to these individuals at like zero or like close to zero exercise price, which is significantly under their fair market value typically. So this ends up like a lot of times they don't realize that this actually happens until the employee starts to do their own personal filings for taxes, etc. And then that gets picked up and then all the penalties start to kick in. It usually comes as a huge surprise to both the employee and the employer, and things start to get a little bit ugly at that point. So the most common mistake is really just granting out all these ESOPs at a point whereby you're not aware of 409A and the exercise price is set so low. Another thing then, it's also, I would say, the idea of it goes back to the idea of not knowing in the first place that you need a 409A. Then the ESOPs, like the ESOP plan that was drafted in the first place, doesn't actually cover all the specific roles that like the US has on deferred compensation. So then in that sense, it gets a little bit complex as to like the legality of things, etc. here and there. So I guess one thing over here is just that like our advice would typically be just try to err on the side of caution, and as long as you are planning to expand to the US and you have some sort of like idea that you might be granting out to any US individual over here, or just giving some form of deferred compensation in general to a US individual, then it might be best to seek some sort of like legal tax advice, etc.
No, I understood. Yeah, so I think that's definitely important to just kind of do the homework and understand what you might be getting into. But I want to kind of pick on one of the comments you made is that, for international companies, the plan design is quite important, right? And looking at our audience, we have representation, as I mentioned, so India, we have Singapore, we have Australia, we have someone from Middle East, from the Emirates as well. So the rules are actually quite different everywhere. So in Australia, there's startup concessions, which are, provide tax preferential treatment for options. But once again, they have their own safe harbor valuation requirements when you have to set a strike price essentially at fair market value as well. but there are different methodology that's applied there. However, in countries like India and Singapore, the rules are a little bit different. So they may be a little bit more flexible and employee friendly when you can give discounted options, right? So not necessarily set at the current share price. So in terms of kind of plan design configurations, how do you keep it fair across borders? Because in a way, if you have to set the strike price at 409 for US employees, but your employees in Singapore, don't have to follow those rules, like what do you see companies do? Do they kind of try to have two different sort of plans? And for US employees, they have higher strike price, for Singaporean or Indian employees have lower strike price, or do you see companies try to equalize it across the board? So I would imagine there's no right or wrong answer, but what have you seen companies do?
Sure. So one thing we definitely see most companies do for sure, this one I can say for sure, is that if you do plan to give out to individuals from jurisdictions that have vastly different rules, so not like India, Singapore with like similar rules, but like let's say India and the US, or Singapore and the US, then it's always best to at least have a sub plan whereby you can cover for the US jurisdiction as well. So your main plan can be for like most of your employees in India, Singapore, or those with like closer rules, and more similar rules. And then after that, have a sub plan specifically for any grants to the US. So this one for sure, in terms of separating the plans, there needs to be some form of segregation, at least to cover off on all the various regulations that are present in the US. The next thing then, in terms of like granting out to the employees across the jurisdictions and trying to keep things fair, what we have seen is like there are two ends to this, I would say. One is whereby like there are some companies who just go by, these are the country rules over here, the regulations. We'll just keep to it and we'll just offer whatever is most favorable to our employees, only considering their jurisdiction. So to their employees in countries which allow for discounted options, they just give it out at discounted options. And then for those in the US, they give it out at fair market value. Where they typically try to adjust a little bit more is by considering the number of the quantum of the grant itself. So then that goes back down to the idea of considering the fair value of the ESOPs. So that in terms of like trying to be a little bit more fair, it comes with a little bit more cost in terms of trying to get that fair values, etc. So after discovering the fair value of the ESOPs and the different types of ESOPs that you plan to grant out, then you can see like based on what is the actual cash amount in that sense that you're trying to grant to them now, the value that you're granting to them now, and then you divide it accordingly to adjust for the quantum that you give. So that is normally what we would say is the middle ground-ish over there. And then the other end of it would then come to a point whereby, because you're granting out to US employees who do require fair market value strike prices, so you just standardize it across the board. So even in jurisdictions whereby allow for discounted options, you just don't do it at discounted strike price. So there are typically these kind of various approaches, and I feel like every company so far has their own preferences typically whenever you raise these points. So it's really just depending on what the board members, what the company themselves feel like it's best comfortable for them.
Sounds good. All right, thanks, Evelyn. And I think it's an important point because there's no one way to do it. So a company kind of has to figure out what makes sense for them. But I guess like ultimately the most important step is obviously do your homework, prepare, get organized internally as the company, as the issuer of that equity. But the final step, which may be even more important, you have to kind of communicate and explain this to employees. So once the company understands what the rules are, that's great, obviously super important, but it's also equally as important for employees to also appreciate what they're getting into. So Evelyn, any kind of final advice for companies to communicate the 409A rules and explain the fair market value, how it all works to employees? So what would you suggest companies should do?
Yeah. So personally, what we feel is that like it's always better to have like some sort of formal communications with the employees on all of this, because ultimately deferred compensation is still part of their whole incentives package, and that always gets a little bit like it's a hot topic amongst employees for sure, because this is what they're getting compensated for their work. So what we do advise is always to have a very open kind of conversation. It might be best to have some sort of like a town hall seminar here and there, whereby you explain the rules and then explain exactly how you've come up, like the logic or the basis, or whereby you're giving out the ESOPs to them. And I think the key thing to highlight is always that as much as the company is trying to keep things fair across jurisdictions, you also have to show your employees and help them to understand that the company is already trying its best efforts to make everything fair and also be compliant with the regulations in each jurisdiction. So all of this, because it is a handful and it's ultimately a very personal touch kind of situation, we do feel it's typically best to have some sort of open seminar knowledge session in that sense with the employees so that everyone gets on the same page.
Yeah, no, that sounds good. And obviously very reasonable to highlight that communication to police is pretty important in an open forum. While you were speaking, there was actually a follow-up question on just to clarify kind of the requirements. So if the US company has non-US employees, for example, in India, does that company still need to set the option value or the strike price at fair market value for its non-US employees? Could you just clarify that point one more time?
Sorry, could you just repeat that, Amit? I lost it a bit.
Yeah, no problem. So if the US company has non-US employees, for example, in India, does that company still have to set the strike price at FMV for non-US employees? Is that a requirement or not?
So that actually isn't a requirement in that sense. So let's say, for example, if you have I think one thing that's quite common is that a lot of companies sometimes do incorporate their company in the US itself, but most of their operations are in another country. So let's say, for example, most of your operations are in India, and all the employees that you're planning to give out to are all based in India and India taxpayers. So they're non-US taxpayers. In this case itself, you don't actually require the 409A valuations. So going back to the key concept again is that when exactly when a 409A is required really depends on who you're granting out to and which tax jurisdiction they are under, or let's say if they do happen to want to change tax jurisdictions, then where they might be in the future. So if you are not granting out to any employees who are not in the US, you don't have to follow 409A rules.
Yeah, correct. So in that specific case, if you obtain 409 valuation report, it does tell you the FMV of the ordinary shares, so what the shares are worth in the company. However, as Evelyn highlighted, if you want to grant options in India, you don't have to set a strike price based on that 409 valuation. So those are the rules that would not be applicable for non-US employees. No, I appreciate it. Thanks for clarifying. So Evelyn, I'm going to ask you to kind of provide us with a sort of a high-level summary. So if someone wasn't paying attention for the last half an hour, what are the key things they need to remember and take away from this session? And when Evelyn's doing that, anyone in the audience, if you have any additional final questions for Evelyn, please feel free to drop them in a comment section, so we'll be sure to address. Otherwise, if there's something you want to discuss, as mentioned, feel free to reach out to us separately. So Evelyn, what are the kind of key takeaways? I think you've kind of prepared something for us as a bit of homework.
Yep. So I think we can just think of a little bit of this cheat sheet over here. There's really just a couple of points that you just need to remember for 409As. So the first thing is just that as long as you are planning to grant out to US taxpayers, then a 409A valuation is a must. So that is the key thing. It's linked to the individuals that you're granting out to and not where the company is based in. Then the next thing is that what exactly the 409A rules mean. There's a bunch of other rules here and there, but the key thing is that the exercise price that you're setting your grants at must be at the fair market value as of the grant date itself. Then in terms of how long is this 409A valuation valid for, it's just the earlier of 12 months or the next significant update to the company's valuation. And then in terms of whether you still need a 409A if you're trying to get an ESOP valuation in that sense, yes, it's different things, but ultimately it's a step 1, step 2 kind of process. In order to value your ESOPs itself, you need to value the company, and that typically comes in line very nicely with a 409A valuation. And the last thing is just that, like, why should you even follow 409A rules? Like, why can't you just take in the penalties? The long story short is that penalties for 409A non-compliance are quite harsh, and it typically comes as a huge surprise as to like how strictly enforced and harsh they can be. So best would be to try your best to comply to these rules. Ultimately, if you do know the rules and you try you're just aware of things and follow according to them, it's not too difficult and not too like not it is not too difficult to follow into these rules. Yeah, it doesn't require too much of a compliance cost.
Yep. All right. I appreciate it. So I think that's a pretty good summary. So if anyone has any further questions and wants to kind of reach out to you for help or wants to have a follow-up discussion, what would be kind of the best way for them to find you?
So you can reach out to us. You can reach out to me personally on my email, like evelyn.tay@capita.com. I think it's shown on the screen now. What you can also do is write into valuations@capita.com, or if not, you can always go onto our website, capita.com as well, to submit a request for like a demo or like just reaching out over there to get some help for valuations, ESOP advisory, etc. Anything you want for equity compensation.
Sounds good. So that was very helpful. So I appreciate that very much, Evelyn. So thanks for your time. And also want to thank everyone else for joining today's session. So hopefully that was helpful and you learned something new. Once again, this can be a pretty complex area and not something that everyone is aware of, but it's definitely an important aspect for everyone to be aware of, especially if you consider either expanding in the US, you have an existing team there, and equity compensation plays a big part of your reward strategy. So we would like to kind of wrap up here. So once again, appreciate everyone's time. If you have any questions around evaluations or anything else you want to find out, so obviously the team in Capita works with a lot of companies across the globe to assist them with various evaluation requirements. So we can help you answer any questions around 409A. And as Evelyn alluded to, we also look after not just fair market value, but also fair value for relevant ESOPs and can help you prepare relevant expense amortization reports as well. So once again, any follow-up questions, we would love to speak with you, but we'll leave it there. Thanks, everyone, for your time, and don't hesitate to reach out to us with any follow-up questions. Thanks very much.